Thanks for joining me in discovering the evolution of Shell's management strategy and why its stock is one of the most attractive in spite of the volatility within the oil and gas sector. In 1997 to 2000, CFROI levels were consistently below the cost of capital, resulting in Shell having a very conservative outlook dictating its decision-making. Assumptions were made that low-price environments would prevail and that the profitability would be low. This means that they did not adequately prepare for future growth opportunities. While competitors focused on paving the road for aggressive growth through M&As, Shell made many divestment decisions as seen in decreasing asset growth. In 2000 to 2007, even though Shell did not invest in more assets, it still experienced high CFROI levels because of extremely favorable market conditions. The period from 1997 to 2007 was known as the 10-year window of unprecedented profitability. Management quickly regret its lack of investment decisions earlier, having fallen behind industry peers in reaping the benefits of soaring oil prices. As a result of low investment in company growth, CFROI has been on a steadily decreasing trend since 2007, as the effects of management's incorrect decision was just beginning to be observed. Fast forward to the situation today. In response to the failure in capturing the price upturn while competitors thrive, Shell is determined to avoid the same mistake and to think ahead to oil recovery scenarios despite this current environment. This introduces Shell's first big M&A to prepare for growth to take advantage of when prices eventually recover, the BG acquisition. Shell has been taking steady steps to ensure continued growth in the future following its peaks in asset growth where it built and invested in major projects. These long-term projects' revenue-generating abilities will not be revealed until further in the future. Sales growth generally drives asset growth, where Shell reinvested in positive NPV projects, spurring CFROI to increase in the following years. The company exhibits resilience and financial confidence to reinvest, even when sales growth is low. The overall decreasing trend in margins is driven by external factors like historically high oil prices falling, declining ability to reap the benefits of lower-cost assets developed from years ago. It's important to note that the cost of acquiring new assets is rising steadily as companies delve into higher-cost unconventional energy to supplement the decline in conventional reserves. The newer technology employed bring higher operating costs, thus lowering the operating margin, a trend experienced by industry peers alike. Asset turnover displays a very clear increasing trend until 2008. Where sales growth exceeded asset growth, asset turnover increased, like in 2009 to 2011, in that corresponding relationship. A prime example is in 2009, where sales growth plummeted while asset growth soared. From 2011 to the present, declining sales growth occurs simultaneous to management's continued asset growth strategy, leading to a steady downward trend for asset turns and CFROI decreasing in accordance. This evaluation brings us to the present, where CFROI levels are forecast to rise significantly based on warranted price. The market seems to have faith in the company despite difficult macroeconomic conditions, where increases in asset growth have been positively received. Forecasting into the future in a price recovery scenario, Shell's prospects are highly promising given its determination to prepare for growth. This is the central theme of my argument. Their key strategy of investing in assets in downturns applies the assumption of oil price recovery, so that an asset developed today will be functional and reap the benefits when prices rise again. While other pressures from OPEC trying to drive weaker firms out of the market with a production plan, this sets up the circumstances of the consolidation of firms where only the financially strong ones survive. In Shell's case, the BG deal is designed to create synergies, fortify financial strength, and integrate valuable assets into its portfolio. BG's strength in the unconventional energy category will augment Shell's future performance in a price recovery scenario because it will have better ability to meet the world's growing energy demands. Now let's take a look at the competitive analysis. Shell should be benchmarked against other fully integrated companies with international presence. Most members of the peer group are also struggling given the low price of oil. Firms face the difficulties of securing growth opportunities because most resources are now owned by national companies backed by governments. The key here is that Shell stands strong compared to peers in its future prospects and performance to date. Highlights include Shell's large market cap, which can be utilized for organic growth and is the reason for their low leverage fueling operational quality, and valuation percentile signaling market confidence. A short-term risk is that stocks may not yield as high a return in the future, and the relative increase in shareholder wealth may not be as attractive depending on how long current conditions persist. Imagine oil prices continuing to slump for a long period of time, adversely affecting Shell's ability to generate income and retained earnings. Less investment is made into new projects and developing existing ones, so the potential return could be lower than if oil prices recovered in the near future. The long-term risk is that because the oil and gas sector is never immune to market volatility and compounding macroeconomic factors, it's always possible to lose money on an investment without thoughtful timing. In conclusion, observing HOLT lens, forecasted CFROI is dramatically higher than the market implied IRR, meaning that large returns can be made in accordance with an efficient market with stocks consistently closing upside. Shell's undervalued stock has a track record of positive market reception on top of having set itself up for profitability in anticipation of oil price recovery with asset growth and acquisitions. This forward-thinking management strategy is all leading to augment the attractiveness of this investment.